Okay, testing. 1, 2, 3, testing 1, 2, 3. The rain in Spain falls mainly on the plains. The ants in France stay mainly in your pants. Stay mainly in your apartments. So, good afternoon, everybody. Welcome to Forex.Today. How are you doing? Me? Well, I'm doing fine. Thank you very much. Today, we got non-farm payroll. No. FOMC. Sorry, habit. FOMC. What are they going to do? Save me, Fed. Save me, Jay. Come on, JP. Save me. Give me some free money, JP. So we'll see if they're going to do any more liquidity events. We'll see how the market responds to what they say. So here's the agenda. First of all, you're going to subscribe, like, and comment. Okay? Second of all, you're going to treat everybody in the chat with dignity and respect. If you're a spammer, if you're a scammer, if you're a flammer, just get out of here. Okay? So we are a community of 13,000 foreign exchange traders, and we're here to help support each other, our mind and our soul. So please be a positive contribution to that. Second of all, I want you to visit tradersway.com. They make these webinars available to you on YouTube. If you find that they're helpful, entertaining, if you're learning, if you just like the sport and the community, then please visit tradersway.com. Also in the description below, there's links to all kinds of resources, my book, training videos at 80% off right now, performance coaching, whatever. There's just tons and tons of stuff in the description below. All right, so let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Okay, so the agenda today, I'm going to teach you everything you need to know about the Fed in 30 minutes or less, and then there's going to be some sort of announcement at 2, and then we're kind of just going to float around for a half an hour, wait for the press conference, and then we'll watch the press conference together as a community. Okay, what do you think about that? KJ wants the long version. Okay, welcome to Forex.Today. Let me remind you that the purpose of Forex.Today is education. This is not alert service. I'm not here to make trade recommendations. However, I will conduct technical and fundamental analysis, and I'll do so in real time, pip by pip, candle by candle, with the overriding goal of helping you put together trade plans through this FOMC trading session. If you're trading along with me using a demo account, then regardless of whether your plans are successful or not, you will have an opportunity to learn. Trading and investing is risky and not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, so please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. I've been saying that disclaimer every day for 20 years. I got that down. My rhymes are tight. You wish you could. All right. So, where are we? Oh, I got to get my la-di-da-di. We likes to party. The Fed. Okay, by the way, look at that. I've made 200 pips since New York today. Since 8 a.m., made 200 and something pips. Nice! Just since this morning. 200 pips raining out of the sky. So anyways, I gotta move. Give me the juice. I gotta move. Give me the juice. All right, so what is the Fed? What is the FOMC? And what in the world is central banking? Trader's Guide to the Federal Reserve Bank. Okay, first of all, the Fed has a dual mandate. You probably know this. They need to keep the economy healthy, but also keep inflation moderate. The economy currently is not healthy, and there is no inflation. So they're not doing a very good job, maybe, right? But check this out. This is different than many central banks, like the ECB, for example. All they do is inflation. But they have very little power to say, Spain, you should do one thing. Germany, you should do another thing. Italy, you should do this last thing. You know, France, you should do this thing. Like, so they can't really, they don't have much power there. Their job is to try to keep inflation in check. But we've found over the years, they're not even good at that. Okay, cool. So how does the Fed do this? Well, they have different tools. they can adjust the reserve requirement ratio, right? This is adjusting, this is how much a bank is required to keep at the Fed. They can also influence excess reserves, and this has to do with that deposit rate. And lastly, they do open market operations, otherwise known as OMO. All of this, OMO is specifically monetary policy. So, for example, the money supply is a vertical line. It has nothing to do with interest rates or the amount of money in circulation. Okay? The money supply is the money supply. It's the number of money. So it's not downward sloping like a demand curve. It's not upward sloping like a supply curve. This is just a vertical line because at any point in time, there's just a certain amount of money in the market. Okay? The amount of liquidity, right? So the Fed can come in and adjust money supply. The Fed can buy bonds. So what they do is they call up one of the 11 bond dealers in New York City. So they call up JP Morgan. Hey, what's up, Jamie? We need some bonds, bro. Right? So JP Morgan says, well, we're happy to sell you some bonds. So the bonds leave the balance sheet at JP Morgan and they go to the Fed. It's now sitting on the balance sheet at the Fed. In exchange, JP Morgan gets money. Then JP Morgan puts that money into their bank account, right? The house account, if you will. And then that gets spent. And that goes to someone else's bank account. And that gets spent. And that goes to someone else's bank account. And that gets spent. Okay? So that money that the Fed gave JP Morgan, what that was a gateway to enter into the economy. And now the economy has that money because guess what? The Fed did this. Hey, JP Morgan. Hey, Jamie Dimon. We'd like to buy $100 billion worth of bonds. So they go la, 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 la on the keyboard. And then they simply send it to JP Morgan. 100B. The Fed gets the bonds. And $100 billion is entered JP Morgan's bank account. Okay. Now the other thing can happen where the Fed says, you know what, we need to reduce the amount of capital in the economy. So they're going to sell those bonds that they bought from JP Morgan. They can sell them back. They're like, hey, world, buy these bonds from us. And that's making the balance sheet at the Fed smaller. So the opposite happens. JP Morgan comes in, gets a good deal on some bonds. They buy it from the Fed. Okay. JP Morgan gets the bonds and the Fed pulls the money out of the economy and destroys it. Okay, and that makes the money supply go down. So you can see they can make the money supply shift to the right, or they can make the money supply shift to the left, either increasing or decreasing money supply. Now check this out. You may not know this. They do this all day, every day. There's a trading desk at the New York Fed that all they do all day is this, either buying or selling bonds. Okay. Now, how does this impact interest rates? Because we have an interest rate decision. So if the Fed cuts interest rates, they're going to have to actually do something, because what you also might not know is interest rates are not law. It's not like the President of the United States mandates that interest rates are something. The Fed steps in and they make interest rates. So how do they do it? So here we have the demand for money. That is downward sloping because it's a demand curve. The more expensive money is, the less demanded. So let me draw it this way. If interest rates were 10%, how much would be demanded? Very little. If interest rates are 2%, what would be demanded? A lot. Okay? Quantity 2 versus quantity 1. The difference being, right, interest rate 1 and rate 2, right? So whatever. So the amount of money demanded from the economy is proportional or related to, let's just say related to, the interest rate. So check this out. So here's an equilibrium point, right? At this, when money supply is here and the amount of money demanded at that supply level creates an interest rate. Okay? Cool. Now, then the Fed jumps in and the Fed sells bonds. So what happens? The Fed sells bonds to bond dealers. Bond dealers give money to the Fed. They have reduced the amount of money in the economy. Okay? They have reduced, right? And we get a new equilibrium point, and the interest rate went from interest rate 1 to interest rate 2. You see that? The Fed sells bonds, the bond market falls, bond prices fall, interest rates rise. Interest rates went up. Interest rates went up when the Fed sold bonds. Well, isn't that interesting? Okay, now check this out. This is actually interesting. I think one of these slides is a typo, but let's check this out. Fed buys $10 billion in bonds. The math here is 1 over R plus E times the deposit. Total deposits rate 1 over 0.1, which is the reserve requirement ratio, times 10 billion, right? The 10 billion that the Fed inserted into the market. So the total deposits is 10 times 10 billion. It turns out to 100 billion? Whoa, wait, what? You're like, Wayne, you lost me there for a second. Check this out. JP Morgan sells the Fed bonds, 10 billion in bonds. JP Morgan now gets 10 billion, right? So what do businesses and people do with money? They spend it. So it goes into a bank account. What is the bank going to do? They're going to park 10%. That's what this 0.1 is. This 0.1 is 10%. They're going to, right, which is the required reserve ratio that banks have to have with the Fed. So check this out. 10 billion goes to JP Morgan. The bank now, the bank side of this, not the bond trading desk, but the overall bank then does what? They park 10% at the Fed, they loan 90% out because they're a bank. That's what they do. Which means someone borrows from the 9 billion. And what do they do when you borrow money? What do you do with it? Well, you spend it. Like if you have borrowed money to buy a house. Well, you borrow the money and then you give the homeowner the house and you get the keys to the house and it's transferred. Like you borrow money to spend it. So they lend the money out, which goes to someone else's bank account. Therefore, that bank has to put 10% at the Fed and they lend the rest out, which gets borrowed by someone else, gets parked at a different bank, 10% gets parked at the Fed. And what happens by the time the cycle goes all the way down to like a $1 loan somewhere, it actually gets multiplied into 100 billion being added to the economy. And this is why rich countries with stable banking systems are rich, because of the fractional reserve banking system. You ever notice like a poor country has terrible banks that nobody trusts? Nobody puts money in the bank. What do? They stuff it in a coffee can and put it in their fridge, or they put it under the mattress, or they bury it in the backyard. It never multiplies. It doesn't become a loan to the business down the street. It doesn't become a mortgage for your neighbor. It doesn't multiply. It doesn't grow. It doesn't do anything, and everybody stays poor. Okay? So the opposite can happen now. The Fed instead buys 10 billion in bonds. What happens? The money supply goes up because, right? They buy the bonds, they add the money into the market, the supply of money goes up and interest rates fall. So when the Fed is buying bonds, they drop interest rates. Cool, right? So what is the Fed? Let's keep moving. What's the Fed? History of the Fed. The United States has tried multiple times to have a central bank. They hate it. Why? Because Americans have a certain point of view. Most people that came to America hated the king. Okay? They hated the king. They don't like centralized power. So they get to the colonies and the colonies get independence. And at the end of the day, they're like, the president of the United States is not a king, nor shall we have a central bank that mandates what we do with our money. So they refused to have it for a long period of time. But what happened was a lot of these banks ended up failing because what happens was there's no safety net in the economy. And so when the economy tanked, banks would collapse and then everybody would lose their money. So at some point, someone had to step in. Well, after the third or fourth or fifth crash over the years, guess what? JP Morgan got to the point where JP Morgan, the person, the dude in the white, was the person that actually bailed out, not a bank, not the economy. He actually bailed out the United States government at one point. And he's like, whoa, 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 I can't keep doing this. This is stressful, right? So, and which is funny because it was all his dad's money anyways. But, so anyways, he actually got to the point where he bailed out the entire U.S. government. So he says, whoa, 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 we got to change something, right? So he and his big buddies from Wall Street and his big buddies from Washington, D.C., they go down to a little place called Jekyll Island, Georgia, where they used to hunt all the time. And while they were there, they created the Central Bank of the United States. It was actually the third central bank of the United States, okay? Because he was sick of bailing out the economy, and he thought, you know what? I don't want it to be my problem anymore. So this is the first Fed meeting, right? That's the Federal Open Market Committee, okay? Now, they had to get this passed into law, okay? So what they had to do is work the political angle of the situation. So they were worried, like I said, people didn't like centralized power, okay? And they didn't want a system that could be rigged. So imagine you're a farmer in Iowa. Do you trust the guys in Washington, D.C.? Do you trust New York bankers? How about way out in California or Oregon? Do you really want to have your life dictated by some Wall Street a-holes or some corrupt politician in Washington, D.C.? You're like, no way am I going to vote for that, right? So they had to come up with a system. So guess what? The United States doesn't have one central bank. They have many central banks. So here's how it works. Each region in the United States has its own central bank. However, most of the money is staggered in either Chicago, New York, or California. Makes sense, right? Now, each one of these central banks has its own stockholders. They actually have stock, right? The members of each regional Fed, they elect 6 directors and 3 reps that come from the Board of Governors, okay? The 9 get together and appoint the president with the approval of the Board of Governors, again, out in Washington, D.C. So each Fed has a president. Like Janet Yellen, for example, was president of the San Francisco Fed. Okay? So the 9 directors of each regional central bank include 3 professional bankers, 3 leaders from the business community, and 3 that are appointed by the Board of Governors. Now, the reason for this is they want a wide-ranging view of the economy, specifically their local economy. That's why they got to have 3 business leaders, because the San Francisco Fed should be able to call up Larry Page and say, hey, what's up? How's Google doing? What do you think about the future? Are you going to hire more people? Are customers buying stuff from you? What do you think about the next 6 months? And they gather all this information. They need to know what's going on. So they have backward-looking data, but they're also doing surveys from local businesses to get forward-looking data, okay? So this is a well-rounded overview of this local economy, okay? So what they do is once they have this forward-looking data from all the local businesses, they compile all the data and they put it into something called the Beige Book. Has anyone heard of the Beige Book? Well, guess what? This gets compiled and sent to the Board of Governors so that everyone knows what's going on during the Federal Open Market Committee. Well, how about this Board of Governors? What are they all about? Well, they are in Washington, D.C., so there's like someone that oversees the entire central banking system of the United States. There are 7 governors appointed by the United States of America and confirmed by the Senate, so it's a very political decision. Now, they serve 14 terms, and they rotate, so the president can't come in and just like kind of play a house of cards and move things around and get what they want. So Trump made Jay Powell president. That was a president of the Board of Governors. That was a controversial decision because he's not even a real economist, right? And then what? As soon as he gets elected, now Trump hates him and he can't do anything about it, okay? So it was designed to be just like that. So they have 14-year rotating terms. Each governor must be from a different region. So you can't just have everyone from the Board of Governors from the East Coast and forget the West Coast, right? And then they get together and they elect the chairperson of the Board of Governors. Cool. Currently, Jay Powell, right? So the chairperson of the Board of Governors, this is a very powerful position. They meet with the President of the United States. They deliver press conferences like the one today. They testify in Congress. They actually have power to negotiate and stuff like that. But they're also the chair of the FOMC. And this is what it looks like right now. They're gathering in this room at the Board of Governor building across the street from the Vietnam Memorial in Washington, D.C. Okay? Cool. So check it out. They meet 8 times a year. They set monetary policy for open market operations, the buying and selling of bonds in real time to manipulate interest rates. Okay? All seven members of the Board of Governors get to vote. The president of the New York Fed gets to vote. Why? Why does he always get to vote? Because they manage the Forex desk, the bond trading desk. They actually do the open market operations. So they always get to vote. Plus they have all the contacts, right? The other 4 of the other 12 get to vote. The other 7 get to talk about things, but they don't get to cast a vote. And guess what? The reserve requirement ratio and the discount rate are not FOMC issues. That's Board of Governor issues, so that won't come up today. Okay, so here's how it goes down. They gather in the Board of Governors office, and they do all their stuff. First thing on day 1. Okay? Or just wait. Okay, so there's the Secretary, Monetary Affairs, gets the speech and all that. All right, let's get to day 1. Number 1 thing they do, they approve the meeting minutes from the previous meeting. 2, the report of the manager of OMO speaks first. The Forex dude speaks first. Why? Because they're the one doing the actual work. Then they get to vote the ratification of the OMOs, and then they tell the Forex guy, okay, go back doing to whatever you were doing. Go back to work. And they continue with the meeting. The Board of Governors staff then do a presentation on the National Economic Outlook. This is called a Green Book. You don't get access to this. So what happens is this PhD comes out and says, we looked at all the data that's been coming in from the Beige Book. We gathered our intelligence, created a strategy, and this is what we think the economy is going to be like now, moving forward in the next few months. This is how we see the economy, okay? Then once that's done, they have some tequila shots, and then they move on. Each president then gives their regional outlook. This is what San Francisco's like. This is what Detroit's like. This is what Atlanta's like. This is what New York is like, so on and so forth, right? But they don't talk about what to do. It's just the state of affairs, okay? Then they go to Applebee's. On day 2, the Director of Monetary Affairs then presents the scenarios. If you raise interest rates, this is what we think will happen. If you don't do anything, this is what we think will happen. If you cut interest rates, this is what we think will happen. And that's called a blue book, which you also don't get, but that gets passed out to everybody. So it's the recommendation, sort of, not really a recommendation, but sort of like, if you do this, this is what kind of happens stuff. Next. Then they all get together and they start discussing. The voting and non-voting members discuss. What do you want to do, bro? What do you want to do? Okay? Once they kind of get there, the president starts putting together a statement, right? Right? They kind of frame the language, then they summarize it. All right, here's what the press release is going to say. The secretary reads out the proposed wordings about their decision, and then they vote. Is this what we're going to do? Yes or dissent? Okay? And then, at 2 o'clock, which is just seconds away, they make their announcement. Then, at 2:30, they do a press conference. Okay? So once again, they conduct monetary policy, they supervise the banks, and they also provide a payment service to, they process your checks. Cool, right? There you go. Everything you need to know about the Federal Reserve banking system in the United States and the Federal Open Market Committee in less than 30 minutes. Woohoo! We're just seconds now away from their actual announcement. So if that was cool, please give me a thumbs up. Could you have that common courtesy, please? Would you please give me a thumbs up for that? They don't teach that at school. Well, I did actually learn it at Harvard, but I already knew it. All right. Yep. Son of a gun. Okay, cool, right? So half of you didn't like that presentation. Well, I apologize. I'm so sorry that was a waste of your time. We're, 2.5 minutes away now? Thank you, everybody. Thank you. Please click the like button. Come on. Right? Tell Google this is quality content. That's all I'm asking you to do. Please tell Google this is quality content. All you have to do is click the little likey button, the little thumbs up thing. Not a big deal. Okay, I'll be back in 30 seconds. Yeah, boy! How low can you go? Boom! That was sick. Thank you. All right. Seconds away. Up. Yeah, they did mess around with it. It's kind of hard to believe. So that's got to be temporary. So okay. Just waiting. Still about a minute, maybe. Maybe 15 seconds. We'll see. Wait for it. Dude, he puts in long days, man. He's a machine.
Let's go to Michael McKee. No change in interest rates as expected. However, a completely different kind of statement from the Federal Reserve.
Cool.
Telling us that the coronavirus is a major problem for the economy. The statement begins by saying the Federal Reserve is committed to using its full range of tools to support the U.S. economy in this challenging time, thereby promoting its maximum employment and price stability goals. Instead of a laundry list of...
So far, no change. You can see the account.
The coronavirus outbreak is causing...
This one's up 400%. This one's up 400%.
Across the United States and around the world. The virus and the measures taken to protect public health are inducing sharp declines in economic activity and a surge in job losses. It goes on to say, the ongoing public health crisis will weigh heavily on economic activity, employment, and inflation in the near term and poses considerable risks to the economic outlook over the medium term. So the Fed is not going to move rates right now. They do say, the same as they have said all along, that they will keep rates at the zero bound and keep their economic and monetary policies in place until it is confident the economy has weathered recent events, is on track to achieve its maximum...
No change in my exotic portfolio.
There was no technical change in interest on excess reserves or reverse repos. Other than that...
All right, so the E, remember excess reserves? No change on the E, no charge on the R.
Agencies and commercial mortgage-backed securities to ensure and support smooth market functioning. They don't say anything about stimulating the economy at this point. So a Fed that kind of consolidated, looked at what happened, and says we're on this.
Still risk on.
We know it's a problem, but we're not going to take any action as yet today. The decision, by the way, unanimous, guys.
Yeah, boy. So we got okay, we don't need to talk to everybody else. Okay, good. So now we got the press conference in 30 minutes. Cool. Cool. Right on. So just looking around, we can check the yens. We'll check the dollars. Let's go. Move it. I got to move. Give me the juice. Let's see. Come on, Baba. I like the way you trade. Mm-hmm. See, let's drop into the hour. See the initial response. Slightly risk on. Slightly risk on. Probably good trades tomorrow. Slightly risk on. Let's move this one to daily. Okay, there's a breakout, so that's trying to move. Okay, across the board, even, even Swissy stronger than yen. So right now, risk on across the board. All yen pairs are moving north. Swissy is probably not the best one yet. Let's just take a look at the indices. There you go, Brad. Okay, Swissy's actually quite weak here. That's interesting, but it looks like yen is turning weaker. But that's interesting. So there's a lot of room here. Aussie looks good. CAD looks good. All commodity currencies seem to be good. Probably stay away from the pound. Dollar is down to neutral, so that's good. So look at Aussie yen, Kiwi yen, Aussie Swiss franc, Kiwi Swiss franc. So for example, let's go over to the Swissies. Yes, the actual press conference is in 30 minutes. All right, so there's your Aussie Swissy change in direction. Okay, let's look. Okay, I'm going to switch this to day trading. I'm going to put it on a bullish template. Okay, and you can see there's a front run off tomorrow's buy zone. Okay, and the next sort of area of interest is here. So this is going to get dragged up. Very cool. We're already approaching. So the last buy zone we had on this was here, and this was the target, so we're approaching that. So we have, as far as price action is concerned, we have this going on. And Okay. So if you're going to stay with that, you can't buy it here. Can't buy it here. Cool little role reversal, though. You had to be quick. Coach, that has to do with global macroeconomic outlook, whether activity is going to be good or not. Okay. So the Fed doesn't feel like they have to do anything special right now to rescue the world, and that's good news. Yes, they confirmed things are bad, but we already knew that. Who didn't know that? But they don't have to do much more, which is great. Okay, so you got to mark the top here, and maybe you'll catch one tomorrow. Maybe you'll catch one later today, but we got to mark that. Notice, though, this is the target we had. Okay, come on. This is the target we were looking at 24 hours ago. Not 24 hours ago. 20 hours ago? 20 hours ago? Anyways. Okay, you see that? It says bullish profit zone for the day. Cool. So what else did we see? We saw Kiwi, didn't we? Let's take a look at Kiwi Swissy. We got one here. Up, up, up. Okay, there's a breakout pattern, so maybe you'll have this. Okay, but notice we finally got out of this consolidation, moving up to the next level, so I would assume something like, imagine this, up, consolidate, up, consolidate. How about up, consolidate? Cool, right? Let's look the other way. What else is going on in the world? Even Euro. But notice how Euro, the buy zone is above us, which is actually a sign that you shouldn't be doing this one yet. So you might have permission tomorrow. This is a dog with fleas. You should probably stay away from it. And then pound Swissy, take a look. Okay, let's put it on a day trade. Day trade risk on would be bullish. And it also says maybe tomorrow. Okay, cool. Let's do a market scan. We'll look at gold. We'll look at oil. We'll look at Bitcoin. Okay. Here's this is gold. We're caught in a range, and notice we're still in the range. So this is a cautionary sign. Okay. This is not going up. This is not going down. The probability of you losing money is pretty high. Take a walk. There's more fun ways to lose money than that. I wanted to move to a different setup, the one that's got Bitcoin. Which one is it? Nope, that's my exotics. Hang on. Well, I guess we can do the exotics. All right, so I have this one. Sunday night I sold Euro South African Rand. Okay. So that's that. 400 pips. By the way, when I translate everything into euro dollar pips, right? So a euro dollar pip on a mini is equal a dollar, right? So I'm up $400 on a $100 investment, so I just call that 400 pips. Okay. How many pips is this in Turkish lira? Probably 30,000, right? But 30,000 what? Pennies? All right. So so we got that one. We got USD ZAR. Same thing. Down, 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 up, up, sell. So I'm short here. And it's come down, 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 down since Sunday. And that's also about 400 pips or $400 on a $100 investment. Peso I missed, unfortunately. I just was not looking the right way. I kind of thought it would do this for me first, but it's just gone. Okay. So long, but risk on. So this is good. This is all risk on. Very good. Okay. Positive global macroeconomic outlook, or at least outlook for risk taking. USD Turkish lira. I sold this one as well. I sold it up here. I think I did it last night though. So this is down, 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 down. Cool. So it's just warming up. Just warming up. It's not making a ton of money yet, but I believe my stop loss is at breaking. Yeah. So I can move my stop even closer if I want. Cool. Nice. Notice I sold off the psych level, sold off the M3. Easy peasy lemon squeezy if you happen to be a risk on. All right. I wanted to find Bitcoin, and I think it's over on this one maybe. Times 3 days worth of swap. Yeah. So like a whole extra 6 pips. All right. So Biddy. Biddy, can't you see? So we had this going up to 8,000. Okay. We had this going up to 8,000, and it's well through 8,000 now. Or was it 9,000? Wait. It was 9,000. Sorry, 9,000. Because of the inside week, we were looking at S1 to R1. So right now it's 9 and some change. So that's interesting. Well, I'll back out on Biddy. And man, I can't get the right time frame. Where are we going to be challenged? Yeah. Okay. So again, this is the target. Okay. By the way, this target we had 28 days ago. Okay. One of the things we discussed in the first of the month is an inside. This one. We discussed an inside month. S1 to R1 instead of M2 to M4. Okay. So we're on our way to 9 and we're almost there. So I think that trade's actually done. Okay. All of this is up, 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 up. Cool. So that's great. The Fed's giving us some gusto there. Take a look at gold. We have gold coming up this week. It hasn't quite done it yet. So we really need a move kind of now if it's going to make it. Okay. So you can see we had this up, 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 like it's a breakout pullback like that. It's a little worrisome we couldn't get above here. But if you're a bull, that way. If you're a bear, you're going to sell it probably around 1720 and take it downtown. Okay. Move. Got to move. Give me the juice. WTI. Okay. Yesterday or on Sunday we were here. On Sunday we identified this as a potential bottom, and what we're trying to do now is thread the needle. If you're risk on for this, you're kind of thinking this over the next couple of weeks, and the big challenge here is this high at 13. So maybe, you know, back down to 10 and then up through to 15. Right? And pound Swissy we already did. Euro dollar I think we already did. Let's take a look at all yen pairs. Let's do this. La 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 la. Okay. I'm going to change this template and look at it from a bigger point of view. Take a look at a confluence. And yeah. I'm going to, well, if you're risk on, you got to drop this into like day trading now. Okay. Like I'm looking at this. Let's look at it for next week. So let's go to swing trading bullish. Okay. And we dropped a little too low, but let's back out and take a look at next week. Next week's buy price is 133. Well, no, 132. Well, the buy for next week's like here. Okay. So I guess on a smaller time frame, you're going to have to decide how you want to play it. Look, there's a buy opportunity. We're stuck here. What do you want? Like, what do you want? Something like that? I think I would want even a higher high than this. So if I were to draw a channel, let's do this. If I were to draw a channel, let's use this arrow. I think I'd do it like this. Okay. So maybe between now and next week, you get an up, you get a down, and then you buy it. I think that's how I'd want to do this because I'm less aggressive on this one. It went too low and I have to back out. Just rules of engagement kind of stuff. Euro yen, we've been short all week. So has it changed direction? Not yet. It'll have to go higher than this. So you got to mark your lines. Okay, gonna mark your lines. So it's got to go higher than that. So it's got to make a new high. It's got to make a new high, a low, and like that. Okay. I have a feeling it won't even do that. I think it'll come down and maybe somewhere between those lines. What will be the main talk? It's called a press conference. They make a statement, and then people from the press ask questions. Yeah, guys, if you can't really carry trade oil because you have to pay 8% a day. How'd you like to be guaranteed to lose 8% a day? Yeah, let's do that. USD CAD was one of the best trades of the week, and we nailed it. Destroyed it. Let's take a look where we are. I got to consolidate these things. I got multiple market scans because of updating MetaTraders. Is this the one? No, that's not the one. That's not the one. That's right, Danny. Oh, Danny boy. All right, here we go. So we had this as a risk on play earlier in the week, then the follow-up trade, then the follow-up trade, then the follow-up trade, and then yesterday at 5 p.m., the live trading group met and we created a trade plan called na 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 na. And the plan was, and the arrow's still there, but let me do it this way. The plan was sell. So we'll go back into there. This was just 5 p.m. yesterday. And you can see the trade plan is still drawn. Check that out. Nice. Ooh. Well, currency strategist, there isn't a think. Okay, so if it's risk on, it's bearish. If it's risk on, no, let me say it again. Yeah, if it's, okay, let me erase. If it's risk off, you're buying US dollars. If it's risk on, you're selling US dollars. Okay, so you got to simplify your question. Hey, Daniel. Sleep tight, buddy. No, but it's not. You're misinterpreting. It's not on a dollar. We're talking about global macroeconomics. This has nothing to do with the dollar per se. Global macroeconomics, fundamental analysis. Okay, so the risk on creates a weak dollar. Risk on creates business activity. Risk on creates trade. Risk on creates investment. Risk on creates a weak dollar. So I don't have like, am I risk on or risk off dollar? That doesn't make any sense. Okay? Okay? Risk on creates a weak dollar. Yeah. All right. Easy peasy lemon squeezy. Oh, my pleasure. That's why I'm here. Let's do some, let me take some requests. What do you want me to cover? I have 10 minutes before we throw on the news. Would you please take an opportunity to click like? Would you please subscribe? Also, if you want my trading tools, they're in the link is in the description below. If you want my book, the link is in the description below. If you need a Forex broker, the link to Trader's Way, the sponsor, is in the description below. If you want video training courses at 80% off, the coupon code is COVID-19 to save 80% off. The link is in the description below. If you need a performance coach to hold your hand and work with you daily, the link is in the description below. There are tons and tons and tons and tons of resources available to help you depending on your mode or your needs. There's an answer. If you prefer to read the book, there's a book. If you prefer to watch videos, there are videos. If you prefer to have a coach, there's a coach. Okay? Get what you need. Stop denying yourself of your destiny. Okay, first request, Aussie USD. Let's go. Let's do Aussie, Aussie, Aussie. Not here. All right, so let's open one up. New Aussie dollar, right there. New Aussie dollar. And thank you to MetaTrader for creating this amazing template. Let's change this. Let's start with Confluence. Pachow. So the first question we always have to ask is, where are we going? The target for the month is above us. Okay? I don't think we're going to hit it, which is interesting because this actually creates a good setup for bears. But under the circumstances now, what it feels like is more of an out of position trade and a counter trend. Okay, but that's 2 weeks from now. Let's talk about today. Let's drop into a day trading template. And we'll put it bull because we're risk on, and check it out. This was the buy zone today. This was the buy zone yesterday. This was the buy zone the day before. This was the buy zone the day before that. There was the buy zone the day before that. There was a buy zone the day before that. And I'm sure if we added it, the buy zone would be here. What do you think, guys? For you to believe that, you would have to see it this way. So the pink line or pink arrow is called strategy. And the strategy dictates whether you're a bull or a bear. The blue is tactics. How and where to actually enter trades. I wrote a book called Strategic and Tactical Forex Trading to help you understand the mechanisms of how the market works. It's not a trading, it's not some weird automated rule-based nonsense. I teach you how to understand how and why the market works the way it does. So let's put it this way. If you're already a bull, up, 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 down, down, buy. 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 Okay? And we're already on tomorrow. You understand this? This is tomorrow's buy zone. But somebody did a front run. And they're in it now off the news. So they're very aggressive. Okay? You'll probably get a move like this. So you might have to, you might have to wait till Friday to get a conservative trade. Okay? Okay, the question is, what about the weeklies? Okay, let's take a look at this from a weekly point of view. So we're bullish, right? Cool. So the trade plan this week was you want to be along this area. And the target was here. So based on what happened last week, it's suggesting the target for this week, but nothing happened last week. Okay? So that means our target is too conservative. Let's check this out on a monthly. And of course, monthly is just la-la land, right? And it just doesn't make any sense on a monthly basis because the month before was so ridiculous. March was so ridiculous and May was a lot less than March. Okay, but what this is telling us is if you're a bull, and I already pointed this out on the other chart, but let me do this again. I'm trying to fit this in. Your target for May, the aggressive target for May is 69. So this says it's going to go up 350 more pips, and then you should probably look for profit taking. Okay? So if you're a bull, over the next maybe 2 weeks, you're going to continue with some form of up, 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 down, down, buy. 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 Up, 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 up. Out! Get out! Okay? This is at metatraders.com. Okay. Cool. Get out! Okay? And that's where bears are going to challenge. Now, bears should probably look for this before they get serious. I have a question about oil and June. June 1st is typically peak oil. But we already hit peak oil this year because we have peak oil, like global peak oil, like nowhere else to put the oil. So this year is different than the last. So don't fit in a typical year with this year. Okay? Past performance does not predict future results. Okay? Cool. Next currency pair. We got 5 minutes. Let's go, let's go, let's go. Would you please take an opportunity to click the like button? Okay. Almost half of you have not clicked the like button. Come on. Kick down, come clean. Don't be a holdout machine. Pound, dollar. Really? What else? USD Mexican peso? So I have a question, which way would I aim? So look at this. Okay. I'm now up over 900 pips. Cool. All right. That should tell you everything, JP. You've already seen it. You have enough information to determine my bias. Okay. All right. Let's take a look at this while you guys are popping up questions. Yen, we did a lot of them already. Euro, dollar, Kiwi, Swissy. I thought we already did a lot of these. Gold. Lungster got 600. You weren't following me, were you? Okay, Swissy is weak. Pound is mediocre. Like, what was the other one? Dollar is weak and pound is weak. And somebody's like, show me pound dollar. Why? Why would you do that? So Aussie dollar we already looked at. It's going straight up. Why? Aussie is strong. Dollar is weak. So you could also look at Aussie Swissy. Guess what? It'll be going up. You could look at Kiwi dollar. It'll be going up. You could be looking at Kiwi Swissy. It'll be going up. Okay? You could look at CAD Swissy. It'll be going up. You could look at USD CAD. It'll be going down. Okay? So, what do you want? Cody, there's two things you should check. First of all, go to the indicator, make sure you got symbol X. 2, make sure you got the template. Okay? And then 3, make sure you got the profile. Okay? If you don't have those 3 things, they're going to look different. Also, these will not work on an ECN account. If you have an I, I missed it, huh? If you guys have an I in front of your pairs, it ain't going to work. Hang on. Hang on, guys. I got to bring up the press conference. My clock must be slightly off. Stick with me, guys. Hang on. I'm bringing up the press conference.
On those least able to carry them. It is worth remembering that the measures we are taking to contain the virus represent an investment in our individual and collective health. As a society, we should do everything we can to provide relief to those who are suffering for the public good. While many standard economic statistics have yet to catch up with the reality we're experiencing, it's clear that the effects of on the economy are severe. Millions of workers are losing their jobs. Next week's jobs report is expected to show that the unemployment rate,
Is he at home?
which was at 50-year lows just 2 months ago, has surged into double digits. Household spending has plummeted as people stay home, and measures of consumer sentiment have fallen precipitously. Hotels, airlines, restaurants, department stores, and other retailers have been particularly hard hit. Manufacturing output fell sharply in March and is likely to drop even more rapidly this month, as many factories have temporarily closed. Overall, economic activity will likely drop at an unprecedented rate in the second quarter. Inflation is also being held down, reflecting weaker demand as well as significantly lower energy prices. Both the depth and the duration of the economic downturn are extraordinarily uncertain and will depend in large part on how quickly the virus is brought under control. The severity of the downturn will also depend on the policy actions taken at all levels of government to cushion the blow and to support the recovery when the public health crisis passes. The Federal Reserve's response is guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. We're also committed to using our full range of tools to support the economy in this challenging time. Last month, we quickly lowered our policy interest rate to near zero. We stated then and again today that we expect to maintain interest rates at this level until we're confident that the economy has weathered recent events.
By the way, thank you for being here today.
Achieve our maximum employment and price stability goals. Of course, lowering interest rates cannot stop the sharp drop in economic activity caused by closures and other forms of social distancing. And low rates will not effectively spur the economy if those rates do not feed through to broader financial conditions or if households and businesses are unable to get credit. The economic disruptions caused by the virus created tremendous strains in some essential financial markets and have impaired the flow of credit in the economy. Without access to credit, families can be forced to cut back on necessities and could lose their homes. Businesses can be forced to downsize or close, resulting in further losses of jobs and incomes and worsening the downturn. Preserving the flow of credit is thus essential for mitigating the damage to the economy and setting the stage for the recovery. We have been taking broad and forceful actions to these ends. To support the flow of credit to households and businesses, foster smooth market functioning, and promote effective transmission of monetary policy to broader financial conditions, we have been purchasing large amounts of Treasury and agency mortgage-backed securities. The markets for these securities play a critical role in the economy, and they came under great stress last month as the scale of economic disruption became clearer and as investors clamored for liquidity. Our purchases have helped market conditions improve substantially.
Join the swing trading group or click on the link to the 80% off video training course. That's how you do it.
Treasury and agency mortgage-backed securities as needed. While the primary purpose of these securities purchases is to preserve smooth market functioning and effective policy transmission, the purchases will also foster more accommodative financial conditions. We are also undertaking programs to provide stability to the financial system and to more directly support the flow of credit in the economy, for households, for businesses of all sizes, and for state and local governments. These programs benefit the economy by providing financing where it is not otherwise available. In addition, by serving as a backstop to key credit markets, the programs can improve market functioning by increasing the willingness of private lenders to extend credit. Many of these programs rely on emergency lending powers that are available only in very unusual circumstances, such as those we find ourselves in today. We are deploying these lending powers to an unprecedented extent, enabled in large part by the financial backing and support from Congress and the Treasury. We will continue to use these powers forcefully, proactively, and aggressively until we're confident that we are solidly on the road to recovery. I would stress that these are lending powers and not spending powers. The Fed cannot grant money to particular beneficiaries. We can only make loans to solvent entities with the expectation that the loans will be repaid. Many borrowers will benefit from our programs, as will the overall economy. But for many others, getting a loan that may be difficult to repay may not be the answer. In these cases, direct fiscal support may be needed. Elected officials have the power to tax and spend, and to make decisions about where we, as a society, should direct our collective resources. The CARES Act and other legislation provide direct help to people, businesses, and communities. This direct support can make a critical difference, not just in helping families and businesses in a time of need, but also in limiting long-lasting damage to our economy. At the Fed, we're doing all we can to help American families and businesses weather this difficult period. When the spread of the virus is under control, businesses will reopen and people will come back to work. We will continue to use our tools to assure that the recovery, when it comes, will be as robust as possible. Thank you, and I'll be glad to take your questions.
Tina Smialek.
Hi, Chair Powell. Thanks for taking our questions. You guys have cut rates to zero.
Oh, please tell me a Zoom bomber is going to pop in and...
The question is, what more can you realistically do to help the economy?
Please.
Where do you see the need for Congress to step in?
So let me say that we're committed to using our full range of tools to support the economy in this challenge.
Can you imagine someone's wearing a horse head?
As I mentioned, forcefully, proactively, and aggressively until we're confident that we're solidly on the road to recovery. And also to assure that that recovery, when it comes, will be as robust as possible. As long as needed, we'll use them. And I would just say we have a number of dimensions on which we can still provide support to the economy. As you know, our credit policies are not subject to a specific dollar limit. They can be expanded as appropriate, and we can do new ones. So we can continue to be part of the answer. Will there be a need to do more, though? I think the answer to that will be yes. I would say Congress has also reacted quite aggressively and strongly with the CARES Act and other laws, several other laws, and that's appropriate. With enhanced unemployment insurance and the Paycheck Protection Program, we've seen an extraordinary, historically large reaction. But I would say that it may well be the case that the economy will need more support from all of us if the recovery is to be a robust one.
This isn't Bloomberg.
Nick Timrose.
Thanks, Chair Powell. Nick Timrose of the Wall Street Journal. I want to follow up on Gina's question and ask what specifically do you think elected officials should consider in order to help return or hasten a stronger return to full employment? And what policy tools did you discuss at your meeting today that might be used to stop a deflationary spiral?
So let me start. I'll take the questions in the order you gave them. So in terms of, if I can say, legislative priorities, we're not responsible for fiscal policy. Those will be decisions for Congress to make. But I would say that policies that protect workers, businesses, and households from avoidable insolvency, that keep businesses going so that they're able to produce goods in it and to either hold on to their employees or quickly rehire them, those are going to be key policies. They'll come with a hefty price tag, but we would come out of this event eventually with a stronger economy and with less long-run damage to the economy. So that's a key thing that really Congress could do over time. In terms of what we can do, I mentioned we have our credit facilities are wide open. We can do more on that front. In addition, we've had extensive discussions, as I've mentioned.
No, Cody, the screens behind me are just one platform.
Look like in coming months over a range of potential scenarios for the economy. We do think that our policy stance today is right where it should be for now. As you know, we cut rates to the effective lower bound. And we've said that we'll keep them there until we're confident that the economy has weathered the effects of the outbreak and is on track to achieve our goals. With asset purchases, we're continuing to purchase Treasury securities and agency MBS in the amounts needed to support smooth market functioning.
You see that, Cody?
So we're doing those things, and I would say that we'll continue to use our tools as needs be.
Steve Leisman.
Steve-O!
Question, Steve Leisman with CNBC. I've got two questions here. First of all, why aren't you announcing or conducting a specific quantitative easing program? And maybe you could explain what
I loved him on This Old House.
Purchases that will be made and the amounts that are to come. The second question I have is the Federal Reserve really taking enough risk to help households and businesses here? In that you just said that the programs that are out there may be best for those who are able to repay loans. But so don't you have a series of programs essentially lending only those able to repay, which is essentially helping those who may need it the least? Thank you.
Hey, I love that free money.
Let me say again, in terms of asset purchases and other measures, we do think our policy stance is appropriate now. We've had discussions, as I've mentioned, over time and done quite a bit of thinking about what we might do in the future. We think for now our policy stance is appropriate. We're not going to change it now. And we're really waiting to see more from the economy. There are a range of potential paths the economy could be on. And I think as the time approaches then we'll address your first question, which is about asset purchases. So, but that's not something we're doing today. It's something that we have talked about, and for now we like our current policy stance. In terms of risk, we operate under the laws that Congress passes. And there are a number of aspects under Section 13.3, and you can see that they've permitted us to, I think, move very quickly and move into areas where
Please subscribe, guys. Please subscribe. Join the community.
So I think we're going places and providing help in places where we never have, and I'm glad that we are. I think it's appropriate that we are. Nonetheless, these are lending powers, and if you read Section 13.3 of the Dodd-Frank Act, or the Federal Reserve Act, and I know you have, it does require that we be secured to our satisfaction, and we can't lend to insolvent companies. It's clear these are lending powers, and we are ultimately bound to implement the laws that Congress gives us. We do not make grants. We can't make grants, and the reason I raised that in my remarks is that I just want to be clear on that. We can do what we can do, and we will do it to the absolute limit of those powers. We'll keep at it, and I just want people to know that we will be at it with the legal authorities that we have until we get through this thing. We will keep using our authorities, but there are authorities that we don't have, and there may be a need for those authorities to be used as well as ours.
Heather Long.
Hi, Chair Powell. It's Heather Long from the Washington Post.
Hi,
I have
hi,
two questions
Jay
for
Powell.
you, both on timing. The first, do you plan to launch the corporate credit facility and the Main Street lending facilities in May or early May?
Crazy
Anything you could
liberals.
give us a
Hi,
sense on
Jay
timing?
Powell.
And the second, in the statement you refer today, the FOMC refers today to a lot of medium-term risks from the pandemic. That sounds like you all think this is going to be a long recovery, a long road to recovery. Can you give any more guidance on how you all see this recovery taking shape? Thanks.
Sure. So
Gee
in terms of
whiz.
those facilities, the corporate credit facilities are near being finalized and will be operating.
What happened to
I would
Mr.
say
Chairman?
Soon, fairly soon. Main Street facility is we're close to announcing.
Dude, you gonna do QE or
issuing
what?
A new term sheet. As you know, we put out a term sheet for comment a while back, and we got a couple thousand comments. We've carefully studied them. We've tried to reflect those in what we're doing now. I think with Main Street, there'll be at least a couple of different kinds of lending going on there. This is a broad area of the economy with many different kinds of credit needs. So we're going to keep at that for some time. I think adding in sectors.
You're in charge of
and
the
lending
Fed.
products. So I think
The what?
we'll probably be continuing to work and expand Main Street for some time, but it won't be done quite as quickly. But the first part of it, I think, will be done fairly quickly. In terms of our statement, so what we said was that I'll just read the sentence. It says, ongoing public health crisis will weigh heavily on economic activity, employment, and inflation in the near term and poses considerable risks to the economic outlook over the medium term. So what we meant by that, over the medium term. So obviously what we're talking about is not right now in the very near term. It's between now and the long term. So the next year or so. And I would point to a couple of risks to the outlook that what we were thinking of. First is just the virus. How long will it take to get it under control? Will there be additional outbreaks? will there be drugs that can either treat it or a vaccine of some kind? So all of that is very much shrouded in uncertainty. The second issue, and this is a very substantial one, is just the possibility of damage to the productive capacity of the economy through a couple of channels. The first is just workers who, if one is unemployed for an extended period, that person can lose the skills that are needed, can lose touch with the labor force, and have difficulty restarting his or her career. So that's a feature of deep and long recessions, and that's something we've got to watch out for. Another is just businesses. These thousands of great medium and small-sized businesses that we have all over the country, they're worth so much more to the economy than the sum of their net assets. They contain, they're job creators. They're really important. And if we see an unnecessary insolvencies, a wave of those, that could be damaging to the performance of the economy over time. So the good news is that we have policies, as I mentioned in my remarks, we have policies that can address those things, but not perfectly. So that's another risk. The third thing I would point to is just the global dimension. This is a very global phenomenon, and we're seeing economic data from around the globe, which is very, very negative, and that too can weigh on U.S. economic performance over time. I would say just on the U.S. economy, there are things you can say. One can say. The first is that in the near term, we're going to see, significant declines in economic activity, significant declines in employment, and increases in unemployment. We're going to see that as a consequence of the virus and the measures we're taking to protect ourselves from it. The next phases are more uncertain, highly uncertain, but we will go through a phase starting fairly soon where we begin to reopen the economy, and probably the economic activity will pick up as consumer spending picks up. Consumer spending, as I mentioned, has gone down quite a lot. It'll begin to pick up as people start to return to their normal patterns of spending. But the chances are that it won't go right back to where we were, because people will, until they're confident that the virus is well and truly under control, then they will be somewhat probably reluctant to undertake certain kinds of activity. So it may take some time for us to get back. It probably will take some time for us to get back to a more normal level of unemployment and ultimately to maximum employment.
Thanks for a great question, Heather.
Okay, James Politi.
Thanks, Chair Powell. You didn't firm up your guidance on, this is James Politi from the Financial Times. You didn't firm up your guidance on interest rates at this meeting. And given the risks that you just outlined, under what circumstances would you strengthen the Fed's commitment to keep rates at the lower bound? And is there any danger to delaying that pledge? And on the credit facilities, what kind of demand are you expecting for the programs that were set up under the CARES Act? And are you expecting them to rapidly reach capacity like the PPP plan did?
Okay, so on the first, as I mentioned, we moved very quickly, very aggressively. We were the first to return to the effective lower bound where we are now. We got there essentially right away. And we think that's the right place to be. We think if you look at surveys, you look at market pricing, the market expects us to be there for a good while, and that's appropriate. So, it's not as though the market is pricing in a near-term liftoff or anything like that. And let me just say, we're not be in any hurry to withdraw these measures or to lift off. We're going to wait until we're quite confident that the economy is well on the road to recovery. So we see our current stance and our current guidance, and I would say the same thing about asset purchases. We see them as appropriate. I've also mentioned now a couple times that we have done a lot of thinking about what monetary policy might look like over coming months, and that would depend on where we are in a range of potential economic scenarios. So we were thinking about that all the time, but right now, for now, we think our current stance is appropriate. So we made no change in it today. Second question was so the thing about our facilities is Treasury still has plenty of equity. So we've said that if demand for our facilities is greater than we've estimated, then we'll expand them. And we have the ability to do that. So it won't be the way the Paycheck Protection Program is, where there's a specific amount appropriated for it, and then there's no more money. That will be unlikely to happen here unless we exhaust Treasury's equity, and we're a long way from doing that. The second thing I would say is, and you've all seen this, is when we announce these facilities, and I mentioned this in my remarks, it's not just the actual lending we do, we build confidence in the market, and private market participants come in, and many companies that would have had to come to the Fed have now been able to finance themselves privately since we announced the initial term sheet on these facilities. So that's a good thing. Companies are out there financing, they're out there raising liquidity. We haven't made any corporate loans in those facilities. We've made the short-term money market loans, but we haven't made any of them. And yet there's a tremendous amount of financing going on, and that's a good thing. So for that reason, the ultimate demand for the facilities is quite difficult to predict, because there is this announcement effect that really gets the market functioning again. Of course, we have to follow through, though, and we will follow through to validate that announcement effect.
Okay, Howard Snyder.
Howard,
Oh,
how
hi,
weird.
and thanks for doing this. I wanted to get you a little more expansion on the timing of recovery and the connection between the health response. You said earlier, I think, that you thought the second half of the year could see a pretty robust rebound. Is that now out of the question? And do you think a steady recovery is really possible until a vaccine's developed, given the patchwork of measures we see taken around the states? Is that going to really lead us to a steady path out, absent a vaccine?
As you know, economic forecasts are always uncertain. Today, they're unusually uncertain, and that's really because so much of the performance of the economy depends on the path of the virus and the success of the measures we take to control it, our success in reopening the economy, and also the time it takes to develop new drugs. And our tools, the things that we do, don't affect any of those things. We're not experts on those things either, but what the experts tell us is that the outcomes are highly uncertain. So this is an unusually new kind of uncertainty added on top of our regular uncertainty. But I will say, I think there are a few things you can say about the path ahead. First, this time now is going to be a time of sharp contraction in economic
So remember,
activity.
if you join the live trading group, we meet in a few hours to set up tomorrow's trades.
Expenditures have declined sharply, business investment as well, unemployment moved up. We're going to see economic data for the second quarter that's worse than any data we've seen for the economy. And they're a direct consequence of the disease and the measures that we're taking to protect ourselves from it. So then we'll enter this new phase, and we're just beginning to maybe do that, where we will formal measures that require social distancing will be rolled back gradually and at different paces in different parts of the country. And in time, during this period, the economy will begin to recover. People will come out of their homes, start to spend again. We'll see unemployment.
Well, give her my apologies.
We'll see economic activity pick up. And when will that be? It's very hard to say. But let's just say, for this purpose, that it's in the third quarter. So, as I mentioned earlier, that could be a fairly a large increase. Given the size of the fall, the increase could also be substantially large, although it's unlikely that it would bring us quickly all the way back to pre-crisis levels. Of course, this is the period as well that carries the risk of new outbreaks of the virus, something we really want to avoid. I think then, after that period, at some point you will have, the kind of formal social distancing measures will be gone, but you'll still be left with probably a level of caution on the part of people who will worry, and probably keep worrying for some time. You would think that behavior will change as people gain confidence. So that the sooner we get the virus under control, the sooner people can regain that confidence and regain their economic activity. I think trying to be really precise about when that might happen and what the numbers might look like is, I think it's very tough to do that.
Okay, Steve Matthews.
Stevie!
Steve Matthews with Bloomberg. Chairman Powell, you've noted a number of times over the last year that there's been a broadening out of job gains with marginalized workers. People have been left out of the recovery over the 10-year period, finally making job gains.
Thanks, Jimmy.
And
welcome to the family.
Minorities, but also many other workers. Do you worry that this recession is going to fall hardest on those workers who struggled and just got job gains in the last year or two, and that it may take years from now before...
See, Jimmy, this guy, he can't figure out how to use his smartphone.
Yes, that's exactly
what
was
it, Steve, right? Steve can't use a cell phone.
So unemployment has tended to go up much faster for minorities and for others who tend to be at the low end of the income spectrum, and it tends to come down faster as well, but it tends to go up faster and be much, much higher. And we were in a place only 2 months ago. We were well into, beginning the second half of the 11th year is where we were. And every reason to think that it was ongoing. We were hearing from
I think he was just the oldest guy, that's all.
Communities that this
They're like, oh, just log in with your cell phone and into the Zoom room.
As well.
He's like, I can't do
It's
that.
heartbreaking, frankly, to see
I don't even want to try.
that's all threatened now. All the more need for our urgent response, and also that of Congress, which has been urgent and large, and to do what we can to avoid longer run damage to the economy, which is what I mentioned earlier. This is an exogenous event that...
Oh, he said exogenous. You got to do a shot.
It wasn't because there was something wrong with the economy. And I think it is important that we do everything we can to avoid that longer run damage and try to get back to where we were, because I do very much have that concern. I think everyone is suffering here, but I think those who are least able to bear it are the ones who are losing their jobs. And
once again, if you just logged in, would you please give me a courtesy like, just a little thumbs up for taking an extra couple hours out of my day to hang with you guys? That's all I'm asking for is a thumbs up. Tell YouTube this is quality.
Hi, I'm Victoria Guido with Politico. The Paycheck Protection Program has experienced some logistical problems because of the speed at which all of this is happening. For the Main Street lending facility, which will also work through banks, what lessons are you taking away from that? And then more broadly, you mentioned earlier this year that
notice from the backgrounds that you shouldn't take a $100,000 loan to get a journalism degree.
Get worried about how much fiscal spending they're having to do in this crisis, whether that should be a concern for that.
So a couple of things. This is different from the PPP, the Paycheck Protection Program, in two ways. One is these are not grants; these are loans. So I don't know that the demand will be quite as strong as it has been for the PPP. I don't know that, but and the second thing is we won't run out of money. It's not a limited pot, so there won't be this incentive to try to get there first and that sort of thing. So I'm hopeful we will very much try to learn as much as possible from that facility and from all the other ones too. We have a lot to learn here, so we'll certainly be trying to do that. In terms of fiscal concerns, so I'm for many years,
every day,
long before the Fed, I have long
every day for 14 years, currency strategist.
The need for the United States to return to a sustainable path from a fiscal perspective at the federal level. We have not been on such a path for some time, which just means that the debt is growing faster than the economy. This is not the time to act on those concerns. This is the time to use the great fiscal power of the United States to do what we can to support the economy and try to get through this with as little damage to the longer run productive capacity of the economy as possible. The time will come again, and reasonably soon, I think, where we
Thank you. We finally got over 200 likes. Thank you. I appreciate that.
To get fiscal house in order, and we absolutely need to do that. But this is not the time to be, in my personal view, this is not the time to let that concern, which is a very serious concern, but to let that get in the way of us winning this battle, really.
Okay, Edward, Lawrence.
Yeah, Julie would ask definitely a good question.
The amount of stimulus on the fiscal side
Yeah,
of
Julie's sharp.
how much weight do you give to finding a vaccine, from clearing that uncertainty you talked about around treatment and whatnot, for the Federal Reserve pulling back on some of the Fed's actions and raising the rates from the zero lower bound? Also, when does that Main Street lending facility get deployed? Because we talked about soon, some businesses
Sorry.
need now.
I don't know why it's so sensitive.
So we don't, we're not in a position to
I'll turn it down.
Make, a reliable assessment of when a vaccine or a therapeutic drug would be ready. And so we're not going to set our policies based on our estimate of that. We're going to just provide the support that we can with the tools that we have, and we're going to keep doing that until the recovery is well underway. In terms of Main Street, so you know the story. We put out a term sheet. We got a lot of comments. We took those very much to heart. We spent a great deal of time here. It's a challenging space because it's many different kinds of borrowers. They have different needs, different sizes of companies, and so we're as I mentioned, we're very close to announcing a new term sheet, which will then become operative fairly quickly. My guess is, though, that we'll keep looking to add products and add different kinds of borrowers to that as we go. And we're well aware of the importance of doing it as quickly as possible. We're very much in touch with the urgency of that need.
Okay, Don Lee.
Chair Powell, it's Don Lee from the LA Times. Just wanted to follow up on the question on the labor market. I know you said that it's highly uncertain, but there are analysts who think that we'll have very high unemployment until even the end of next year, as high as 9%. And at this point, can you just talk a little bit more about what you see as the path of employment in the coming months and into next year?
Sure. So unemployment's going to go up to a high number in the second quarter. Uncertain what the number will be. And that's because so much economic activity has been shuttered, really, as we take social distancing measures. So sometime fairly soon here, and probably gradually and at different paces at different parts of the country, we'll see the social distancing measures roll back. People will begin to spend more money. It's really consumer spending has fallen precipitously. And once that starts to happen, people will get hired back and unemployment will go back down. I don't think it'll get anywhere near the historically low levels that we had as recently as February, 3.5%. I think it will take some time for that to happen, for us to get back to anything that resembles maximum employment. But, I mean, the main thing we want to get back on that road. We want to get that recovery going and get people back to work as fast as we can. Not faster than we can, but as fast as we can. And the main thing is to get into that stage where the economy's healing, where we have the disease under control, where we don't, take too much risk of second and third waves and that sort of thing, and get people back to work. And it's again the path of it is highly uncertain, but we will.
I think it's done. I was hoping to hit 1,000 pips before the end of the webinar.
Supporting that recovery.
Scott Horsley.
Scotty, she can't take much more.
After the financial crisis, banks were instructed to up their capital so they could weather an economic shock. What kind of steps do you think we need to take for the economy writ large?
He's got it on his lap.
More resilient.
He's like, well, it's a laptop.
Can you just say that part? You're a little bit low volume.
Yes. What kind of steps could we take to help the economy as a whole be more resilient to this kind of exogenous shock?
It's an extraordinary shock, unlike anything certainly that's happened in my lifetime. And A couple things come to mind. I think the time will come for a careful assessment of the answers to those questions. It's early to be asking them. We're still putting out the fire. We're still trying to win, and I think we'll be at that for a while. But I'd point to a couple of directions. We worked hard to strengthen the banks, much higher levels of capital, liquidity, a far greater sense of what the risks are they're running and how to manage them. So the breakdowns that we've seen in market function have really been in the capital markets, and I wouldn't rush in with prudential regulation into the capital markets. But
so the way that
and we did plenty of things, tri-party.
The way
we did a lot of
that the
reform
market's
in the capital
responding
markets, money market reform, tri-party
is
repo
the Fed's
reform,
done enough.
central clearing.
The
all
Fed's
these
willing to
important
do a little more
things,
if needed.
But there will no doubt be.
He hasn't said anything to contradict
the
himself
size
in
and force of
the
this shock
press
will
conference.
no doubt
So
reveal weaknesses.
It's essentially
in the
risk on.
financial
Yen is weak, dollar is weak,
architecture,
Swissy's weak,
and
commodity
we'll have to go to work
currencies
on
rally.
I also think it.
Nobody wants to buy the euro or the pound.
It tells you the importance of getting your fiscal house in order.
So it's cool.
The U.S.
I think generally that's good.
Really hadn't.
So I'm just waiting to go over 1,000 pips for the week,
on fiscal,
and then I was going to shut it down because we got a 5 p.m.
So we have an already high level of debt to GDP,
So if you want to work with me every single morning, become a subscriber of Forex.Today and open up a trading account at tradersway.com. If you want to join my live group, where we plan trades hours, days, and even weeks in advance. If you want to join that advanced group, the link is in the description below. If you need training videos, I think there's like 35 to 45, maybe 50 hours of training videos right now because of COVID-19. They're 80% off. That is the link below. So I got to go because in 2 hours I'm doing yet another webinar, but this one with the private group. And again, we're setting up trades for tomorrow. We just do it today. Yeah, we set up tomorrow's trades today because we're the boss. So thank you for being here. Thank you for your thumbs up. Thank you for your time. Thank you for your positive energy. Thank you for all the effort you put into this. Thank you for all your compliments and treating each other with dignity and respect. I appreciate you and the efforts you put into this. There are tons and tons of resources available to help you succeed and achieve your destiny. Hopefully you reach out and find whatever you need, whether it's a book, whether it's videos, whether it's live coaching or whatnot. There's lots. And again, thank you to Traders Way for being the sponsor of this community. Without Traders Way, I don't know what. So thank you, Traders Way. Please visit Traders Way and at least open up a demo account just to say thank you. Give them an opportunity to earn your loyalty and respect too. Thank you guys. See you in a bit. See you in the morning. See ya. Be safe. Be healthy. Peace out.